Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking to Phil Taylor, who is President and Chief Analytics Officer of FinMason. This is an exceptionally timely conversation because I know a lot of people have questions about asset allocation, and Phil has written just on that topic. Previously, Phil led the capital markets desk at Lazard, and for 20 years before that, he worked as an arbitrage portfolio manager for banks and hedge funds. I should also technically welcome Phil back to CFA New York because he had a really good career at this organization. He was chair of the board of CFA Society New York. He earned his master's and his bachelor's in mathematics and management from the University of Cambridge. So, welcome back, Phil.
Thank you, Rob.
So, as I said just a second ago, a lot of CFA charter holders are thinking about, or probably thinking back, I should say, to the time when they were taking the exams and learning about the efficient frontier. Asset allocation is always shifting and rebalancing is often part of the game. But right now it's particularly difficult as bonds are rising. The outlook for equities is sort of uncertain, and the rate of the increases of rates was pretty well unprecedented. So I believe some of your work will shine a lot of light on this topic, and that's why I think it's important for us to talk with you today. So could you start by explaining the set of models of estimators that you've developed?
Yeah, absolutely. So at FinMason, we take a very data-driven approach to things. So obviously, I, like everybody in this industry, have my own opinions, but we try to stick to the numbers as much as possible. And so using our extensive database, we've built a series of models where we use a 16-factor global macro model, and we have a model for each of those 16 factors. And the approach we take, which is a little bit unusual, is rather than looking at estimates for the next year of returns, as many firms do, we actually take a longer term view and think that what's more important probably for long term retirement planning and wealth planning is a longer term view. So we look out 10 years, and our models go back with data many decades and then try to find patterns that we can use predictive variables to predict out 10 years in the future. Probably the most obvious example of that is that we use a Case-Shiller PE ratio for the S&P 500. And turns out that's actually a pretty good predictor for the 10-year forward return.
Right. So I think a lot of the members probably just, sort of try to steer their cars a little more straight or, dropped whatever they were doing when they heard 10 years. So could you dig into the analytics that gives you the confidence over that interval?
Yeah, like I said, again, we run the models many decades back in time. I think we go back to the 50s. So we look at the predictive power of the variables that we use and model those. Basically, just do fairly simple regressions. We're not doing any fancy AI and stuff, but fairly simple regressions using those input variables, multi-factor regression analysis, and again predict each of the 16 factors that we look out into the future. And
Yeah.
that gives us that gives us a pretty good picture, we think, of where we could reasonably expect those long-term returns to be in the future.
Yeah, and I think that's one of the difficult things when you use something, simple, so to speak, as multi-factor regression. The place you come to next is what could go wrong with the model. So how did you all answer that question and apply analytical approaches to that?
Yeah, well, obviously, the past doesn't predict the future, as we all know. So we're all doing the best that we can just to have some reasonable idea of what might happen, based on based on math. What could go wrong? Well, obviously, we can get into periods of time where markets and economies behave very, very differently than they have in the past. But we do think with this very long-term view that there is a decent amount of validity in that. And one thing that we specifically test the models for is to make sure that the predictive power isn't like declining over time. So we're not saying, well, okay, we'll look back 50 years, find something that worked for the first 40 of those, but hasn't worked for the last 10, because that's probably a pretty good indicator that that's not something you want to pay too much attention to.
No, no. This term makes me exceptionally interested in how the model does respond to things that were maybe a little bit unexpected. So one of the things that the greatest examples that's more recent is the performance of equities in the last quarter of last year. So fourth quarter equities were surprising to most people. Was the model surprised? Was it?
Again, we're looking out 10 years in the future, so it doesn't really tell you much about the next quarter or
It
the next.
comes out in the wash. Yeah.
Yeah. What it does do, though, in general, and we can talk about some of the results, is that it does tend to be sort of a mean reverting model just by nature. And so, it tends to prefer the things that have done least well
Okay.
in recent periods,
Okay.
not the things that have done most well. To give you kind of almost the most dramatic and obvious example from the model is to look at our S&P 500 model. If you look at the last 10 years through the end of last year, you've got exactly a 12% return for the S&P 500, which is in fact in excess of what most people's expectations would have been, right? If you look at CMA's the last 5 to 10 years, probably very few of them said 12%.
Right. And what is the historical over the last 50 years? The S&P is closer to five. It's closer to eight.
Right, exactly.
Yeah. So
So given that we've had this very extended period of very, outsized returns, I would describe it as, it's probably pretty. I mean, it seems intuitive that any kind of long-term model you'd call upon would probably give you a lower number. And so we actually model out 5% for the next 10 years, which is pretty shockingly low. But again, based on just that Case-Shiller PE long-term PE ratio, that's still pretty high. And so, again, looking out, it doesn't think S&P 500 is a super great investment for a period of time, but that doesn't mean it couldn't go up, a lot over the next 1, 2, 3, 4 quarters or even longer.
right. And perhaps we can in a second come back to how you communicate that to clients because you're talking to practitioners here who understand all that stuff. But clients, that's what 2.5% below what probably most asset owners have it pegged at. So but let's get back to that in a second. Were there other things that are sort of exceptionally interesting in how it expresses the mean reversion? Is it like big on frontier markets now, or like
It does favor emerging markets, certainly. Frontier markets are probably a little bit too sort of small and changing and undefined and poorly defined for a model like ours to really focus on well. But yeah, emerging markets, by contrast to the S&P, the 10-year historical is 2.9, and our model predicts out 8.4 over the next 10 years.
okay.
So definitely would say again, if you've got that long-term view and that long-term patience, probably you want to have a reasonable amount of allocation there.
hmm And most people should, if they are basically either have fiduciary responsibility over a retirement account or the person self-directing their retirement account, right? Although it's hard to do, but so maybe we could shift a little bit to how do you talk to people about this? Because once again, that is, we have generally speaking different, a lot of asset owners with very different forecasts in place. I don't know what the average wealth advisor is recommending because that's hard to count, but I would guess that for S&P it's higher than that. So how do you talk to people about this?
So we don't directly interact, to be honest, with a lot of even a lot of wealth managers, let alone with their clients. We provide tools so that they can do the research based on the data and very much come up with their own stories. But another critical element of what we do is we're not just forecasting forward returns. That's one piece of the puzzle, but the important thing as well is to consider that no matter what forward red wiggly line you draw on a chart, you're going to be wrong, right? So the
Right.
question then is, how wrong are you going to be? And so we also look at forward volatility, which
Mhm.
turns out, as you probably expect, actually does model historical volatility pretty well. Again, over long periods of time, volatility of asset classes is fairly stable. And so what we do is we not only draw that forward return line, but we also draw a Monte Carlo simulation around it. So we can say, well, okay, here's a reasonable expectation of what might happen, but what's a good scenario? Maybe the top 90% of scenarios, and what's a bad scenario? The bottom 10% of scenarios. We can even go to the bottom 5%. And really, I've always liked the maxim of, hope for the best and plan for the worst.
Right, right.
And so we believe that wealth planning solutions should really be focusing almost on that bad case scenario and say, well, I can't protect myself against the end of the world, but I can predict myself against something that is kind of in the ballpark of something that might reasonably happen. And that's a pretty good way of thinking about wealth planning.
Okay. How did you all come to the top and bottom 10%? And not say 12% or 15% or,
Yeah, I mean, we show 10 and 5%, and we can even customize a lot of our analytics and show different grades that people want. But 10% seems kind of like a it's just an understandable number. A lot of the times, the most important thing is to explain things in terms people can easily understand. And everybody understands 10%.
In a bell curve, it does cover the tails, right?
Yeah,
Yes.
exactly.
Yeah, when you're saying that. So I thought this was kind of a novel way of explaining all this stuff. Is to say, what's the Fin score?
So our Fin score is a 1 to 100 risk score. In fact, for one of our real strengths here is that we can not only apply all of this data analytics to individual funds or asset classes, but also to portfolios. So the other key part of what we do is we say, well, obviously you want a diversified portfolio. Hopefully everybody understands, the importance of that. And so we can take a diversified portfolio that has exposure to all of these asset classes and give you a reasonable estimate again of the expected return and the expected volatility and draw those Monte Carlo simulations out into the future. And so that's the way to then communicate not just these little pieces of information, but try to get a big overall picture of an individual or an institution's future might look like, and where they want to be on that bell curve of outcomes, as you said.
Okay, great. Well, let's maybe this is a nice time to put the Bitcoin ETF fly into the ointment because the new issue, and I should preface this by saying a lot of people feel a lot of different ways about the Bitcoin ETF, and you are entitled to your opinion, but it is here. So it raised some interesting asset allocation questions. Right. So where does it go in the asset allocation subsector arrangement? And, connected to that is how much do you allocate to it? So you all have done some work on this. What do you say?
Yeah, and again, certainly agree with you that there's a range of very passionate opinions out there on both sides, but it is becoming more and more, ever more part of our world. And with the Bitcoin ETFs now being approved by the SEC and growing very rapidly, I'm seeing that at least the two biggest ones are getting very strong inflows over the last few weeks since they've existed. And clearly it marks a change because previously you had to set up some account or wallet with somebody you've probably never heard of.
Right, some custodian somewhere.
Yeah, exactly. And so now you can go to your mainstream wealth advisor, you can go on your Vanguard, Schwab,
Yep,
Fidelity account,
right
and
online. Yep.
you can participate in these ETFs without doing any more paperwork. So that really we think that does changes the thought process a little bit and kind of makes everybody think about it. And from a diversification point of view, we did a little bit of work with our optimization engine, and it shows that sort of reasonably you could go up to maybe like even as much as a 15% allocation. Not sure I'd recommend that. I'm not sure I
Wow.
would do that personally.
Yeah.
But at least you can say that you probably wouldn't want any more than that because you're not going to get any diversification benefit beyond that point.
Right. Right. It's exceptionally difficult to, put into most of these types of engines because as we were talking in the prep for this podcast, the time series is kind of questionable. For much of the time series, there were not that many people trading it. So, it makes it kind of difficult to look at from the frame of the work you're doing.
Yep, no, and that's a fair point. Things do change, and you never know how things are going to change in the future, other than they're going to change in different ways than they've changed in the past. The unknown unknowns are always, but from at least from a thought and a data-driven point of view, you do the best you can and do the work based on the information you've got.
Yeah, so I would just mention here to the members who are listening to this that both of the papers that we've referenced here are now available on FinMason's website, and we're going to have them in the show notes here so you can find them on CFA Society New York's website. So, as I said at the outset, if you're struggling with how to change even within the range of your asset allocation perspectives, you really want to check out the work that FinMason's been doing and call up Bill. He donated a lot of time here. I'm sure he'd be generous with speaking with people who are CFA New York members after his contributions here. So, thanks for sharing your views, Bill.
Thank you, Rob. I really appreciate the opportunity to speak with you today and to share a message with your viewers.